Hi, I'm Joel, Director of Capitalised Business Finance. In this video, I'm going to be talking about invoice financing. How does it work and what a financier looks for when considering which invoices to finance? But firstly, just to let you know who I am. I'm an independent business financier who's helped many businesses achieve complete cash flow control through tailor-made financing solutions such as selective invoice financing, supply chain and trade finance, and short-term business loans. Over the years, I've learnt a lot and seen many business owners make mistakes that have cost their businesses dearly. Mistakes that can be avoided by some basic understanding of how this industry works and what to look for when searching for a business financing facility for your business. One of my goals is to provide the knowledge to empower other business owners to achieve success. The more positive, motivated, happy and successful business owners we have in our society, the better our lives will be. I'm also a property developer and investor, and I'm passionate about helping good, honest people succeed. I don't come from privilege. My parents came to our country with one suitcase of clothes and couldn't speak English. I'm self-made, and from personal experience, I'm a firm believer that everyone has the opportunity to be whoever they commit to be, but they must commit and put in the effort to succeed. So, let's get into it. As discussed in other posts, Invoice Financing is a business financing tool that brings forward customer payments prior to the customers paying the invoices. It's for business-to-business invoices. There are some variations to the level of services between financiers and facilities, so invoice financing can also be known as debtor financing, accounts receivables financing, and factoring. There are 4 basic steps to financing an invoice. Step 1. You complete the task your customer has requested. You've delivered a product or provided a service. Until that task is complete, the invoice has no real value and step 3 cannot occur. Step 2. You issue your customer an invoice stating the delivery or service completed, the cost or amount due, and the due date. Depending on the size and type of the invoice, it must include a number of things. The Australian Government Business website, www.business.gov.au, search under How to Invoice, provides the details of how to correctly invoice your customer. Step 3. You can then finance the invoice through a business financier. This is simply a buy-sell agreement between you and the financier. You sell the invoice to them and they buy it off you. The amount a financier will pay for your invoice varies between financiers and can be dependent on the type of product or service you have provided. I will discuss this soon. Step 4. When the customer pays the full invoice value, you receive the balance minus a financing fee. This is called the residual. So they're the basic steps to invoice financing. As I said, there are variations between financiers and facilities, but these are the basic steps. Before discussing what a financier looks for when deciding whether they can finance an invoice, it's important to understand that every time a financier advances money to you, they look for as many exits as possible. What's an exit? It's anything that can occur which will extinguish the debt. It could be that your customer pays the invoice, or perhaps you're refinancing a property and the exit is payout by the incoming lender. Or it could be that an exit is the possession and sale of an item offered as security for a loan which is in default. Understanding what your financier is looking for helps to understand how invoice financing works and why there are variations between financiers. When it comes to invoice financing and exits, there are 3 fundamental aspects to each invoice that is considered. Think of it as a 3-legged stool. The 3 legs are: 1. What is the strength of the customer or debtor? The first exit is that the customer pays the invoice. This is what's supposed to happen. Being the first exit, having a good, reliable debtor is important. I talk about debtor issues impacting invoice financing in other posts exploring full book or whole of turnover, invoice financing versus selective invoice financing. Specifically, how sometimes having a good, reliable debtor still results in non-financeable invoices. 2. What is the strength of the invoice or debt? This, to me, has 2 components. The first component is the contract the invoice is governed by. In some industries, like construction for example, invoices are issued at the completion of each progress stage. The invoices are progress claims. The value of the invoice is subject to change based on offsets against the invoice, things that the customer can claim against the supplier, like the cost of delays, the cost of repairs, or cost of materials supplied. In these examples, the actual invoice value isn't 100% certain. Some financiers won't finance progress claims, while others will manage the risk by adjusting the advance rate or looking for other forms of security or exits. The second component of the strength of an invoice is how disputable the invoice can be. Take for example, a customer asks you to move 10 tonnes of dirt from point A to point B. When the 10 tonnes have been moved and the customer confirms that's the case, it's quite hard for the customer to then dispute that the work wasn't completed. On the other hand, if a customer asks you to write some software to perform a specific task and you complete it, it's relatively easier for the customer to dispute the invoice by stating that the software doesn't perform as required and then delay or never pay the invoice. This is important because the financier will always consider what will happen if my client's business ceases to trade. When businesses cease to trade, customer payments can be much harder to collect, which is why simple, provable debts are more favourable to financiers. They are looking for the strength in the invoice to collect the debt even if the client ceases to trade. It's important to note here that the more evidence you can collect to support your invoices, the better position you will be in to collect payment, whether the invoices are financed or not. If your customer's business goes into administration, you may be dealing with an administrator and they will be looking for every evidence to support your claim to payment. 3. What is the strength of the client business? In other words, if the debtor doesn't pay, is the client's business strong enough to complete an alternative exit, usually an invoice swap or perhaps a buyback? With most financing facilities, the client provides a guarantee, though not all. We have some facilities that don't require this. The guarantee that the debtor will pay the invoice, else other arrangements are made to settle the debt. I sometimes come across a misperception with business owners that all invoice financiers simply purchase invoices without any recourse to the client. There's a fundamental flaw in this thinking that I'll explain in 2 parts. The first part is that when making decisions on which customers to provide supply to, an invoice financier is not normally part of the consideration panel. They don't have a say in who you do business with. If you decide to provide supply to a low quality, poor debtor who rarely pays his suppliers, you can't expect anyone to finance those invoices. So it logically follows that you carry the risk of your customers not paying since you took the decision to provide supply to them. Hence, if your customers don't pay, the financier will look to you for another exit. As an aside, being a good customer pays off in many ways. I'll talk about this in another post about supplier finance. The second part of the explanation is to understand that financiers advance funds to you and the agreement certain things will happen. That is, that you will perform what is required as part of the funding arrangement. Performance is a fundamental aspect when it comes to any forms of finance. Your financier advances funds in exchange for you doing certain things. In the case of invoice finance, this performance is that your invoices are not in dispute, you've provided the supply as stated on the invoice, and you've supplied to a good, reliable customer. If you haven't performed in these aspects, then you're breaking the agreement, in which case the financier may look for alternative exits, which obviously comes back to the strength of your business. So we've discussed how invoice financing works and some of the fundamentals that a financier will consider when deciding which invoices to finance. The invoice financing market is unregulated, meaning that, unlike a bank, invoice financiers aren't held to strict regulations like banks are. Whether they follow the regulations is a discussion for another time. Basically, financiers write products and rules that suit them. No 2 financiers are the same, and no 2 invoice finance facilities are the same. Different businesses will receive different products even from the same financier. So it's very much a case of buyer beware when searching for an invoice finance facility. But don't let that scare you. Invoice financing is a powerful tool, and when selected and used correctly, can help a business immensely. It only takes a basic understanding of the important factors to consider to avoid making a mistake, because sometimes mistakes can be very costly. Understanding what you need is the first important step in any process, and I'm talking more than just, I need a cash flow solution. You need to understand how frequently you would need to use a facility, how much you would draw on it, whether it needs to be able to grow with your business, whether you need to be able to exit it quickly, and how much flexibility do you need with the facility and the financier. That is, Whether you need a personal financier who can tailor a product to fit your business, or whether you're happy dealing with just another employee who tries to fit your business into their model. After you know what you need, it's time to start looking for exactly that product. Some financiers will specialise in certain industries or sectors, providing specific financing solutions for their clients who operate in those industries. Others will provide finance for every business, but in reality, their facilities will work better with some businesses than with others. The point here is that you, as a consumer of these facilities, need to be confident of the fit between the financing facility and your business. Sales employees of financing companies are paid commissions on the number and size of sales they make. Their motivation is to sell. Your motivation is to grow your business with complete control. As mentioned, there are many different types of invoice financing facilities on the market from many different lenders. But in general, there are two basic types of invoice financing: selective invoice financing, where not all invoices are financed, and whole of turnover or full book invoice financing, where all invoices are put through the financier. Understanding the differences between the two main types is important because although invoice financing is simple in design, it can be complex in execution, which is where many businesses encounter problems. So be sure to check out my other posts talking about selective invoice finance and full book invoice finance, looking at the tricks and traps some financiers use that can hurt your business. Thank you.